So why is volume important when we're looking at the market? So analyzing volume provides a huge advantage to traders, yet it is often overlooked by the majority of participants. I was looking online and I saw that over 90% of retail traders completely ignore volume and focus solely on technical analysis. So volume analysis can actually help your trading to develop an edge on top of your technical analysis. So these are the 4 key benefits that you'll find by using volume in your trading. Number 1 is a non-lagging indicator. Some of you may know what that is already. But by looking at volume, we can access immediate data from the markets in real time. Most of the indicators we're currently using are lagging, as you probably all know. So if we can master an indicator which is non-lagging, this could provide us with a good edge over other participants, potentially over 90% of retail guys. Number 2, the indication of activity of larger players in a market is shown through their volume. So all of us want to know, right, what the bigger players are doing in this market. They leave no trace of what they're up to on the markets, apart from one thing, that's their trading volume. They can't hide that completely. They've got ways of hiding certain elements through dark pools and so forth, but they can't hide all of it. It's the big players in the markets that move the markets, obviously not you or I. So if we can understand when they step in, it might help us understand where they want prices to go, and so that we can trade in the same direction as them, not against them. Number 3, identify the strength of trends and when they are losing momentum. So this is key, right? An analogy on the next slide will help you understand what I mean here. But essentially, we need to understand how much energy there is in each move and when that energy is running out or beginning to change direction. Finally, changes in volume tends to lead to price changes. So as I've just mentioned, if we can understand when momentum changes, we can better understand when prices might begin to change as well. Okay, so key points there on why it's important. So I like this analogy. This is how I want you to start to think about volume in the markets. Consider a car going up the hill. Your volume is the accelerator of the car, so the gas that's being applied. The price movement is the actual car motion, and the universal level of resistance or support is the actual hill. So let's think about that. If the car is expected to keep going up a steep hill, do you think gently pressing the accelerator would do the job? The forward motion of the car going up the hill can't possibly be long-lasting unless there is more power or gas applied. What if you were to press the accelerator to its maximum capacity, yet the car motion is still stagnant going up the hill? That should be a huge clue to you that there is sufficient resistance, i.e. selling pressure, that requires further gas, or what we would call buying volume. Hopefully now you should be able to understand how volume can help us understand the strength of moves or trends, or when momentum is falling and where a reversal may take place. We'll explain more with some examples later on to highlight that in a bit more detail.